Hello, I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and welcome to our second presentation in our week of webinars looking at all things smaller companies. Today, we head a little closer to home with a presentation from Gervais Williams, one of the managers of the Miton UK MicroCap Trust, also known as MINI. Gervais, alongside his co-manager Martin Turner, take a diversified approach to selecting companies from the smallest end of the market cap spectrum, leading to a core offering for this very exciting area of the market. Gervais argues that the negative sentiment shown to the UK stock market has made this one of the best investing opportunities in 30 years. For those of you who are new to the format, Gervais will speak for around 25 to 30 minutes before handing over for about 15 minutes of Q&A. You're welcome to propose some questions in the box, and we will put these to Gervais at the end. So without any further ado, I'm delighted to hand over to Gervais to talk through the exciting opportunity set in UK microcaps.
Thank you, Ryan, and it's a pleasure to be here. The presentations, as nationalism displaces globalization, why does this specifically favour a UK microcap strategy? So you might say that's quite a big stretch, but I want to go today through to explain really why we think actually there's a link between this change in politics and ultimately the behaviour of investors. Specifically, the agenda talks a little bit about the nature of change coming through. You know, we've got passive strategies dominating the world. In truth, really, what's going to stop that, if anything? Certainly, we've seen globalization, which has been very much associated with abundant liquidity, market liquidity. And if we assume that nationalism is the opposite of globalization, then perhaps we should expect market liquidity to be tighter and actually profit margins, which have moved to record levels around the world, to come down to more normal levels. And if that does happen, what does that mean for investors? Thirdly, if asset valuations are potentially peaking, stock markets have high valuations, if markets don't go up much more, and particularly if asset returns are not easy to access, why should that prompt investors to actually think about the UK stock market, let alone anywhere else? And then the last point is, the prospects for the UK economy are probably no better than any other global economy. If that is the case, why should global investors ever consider investing in UK microcaps, let alone small caps? So it's quite a stretching agenda in my view. So the very first point is to talk a little bit about the past. We've all been here to some extent previously. Back in the 2000, the dot-com boom, companies like Nokia, like Vodafone were dominating the world. And most particularly, many of them became some of the biggest companies in the world. Vodafone was over 10% of the FTSE 100 index, for example. Nokia briefly became one of the biggest companies in the world. What was interesting about that wasn't so much that they were several hundred million, but several hundred billion. But most particularly, what was interesting about them was actually all that excitement about the future was not very much priced in. People generally, investors get enthusiastic about things, and sometimes the momentum goes too far, and the actual downside gets miscalibrated. Specifically, obsolescence risk, the risk of someone developing a new product which can overtake your particular technology, is in many cases not priced in. And when these companies suffer a setback, clearly not just investors lose a lot, but the indices, the mainstream indices, also don't perform well. As you can see, the scale of Apple, Nvidia, in fact, is somewhat higher than this slide shows. This was some data earlier in the year. And most particularly, even companies like Tesla, which have been very strong performers, are multi-trillion, not multi-billion, multi-trillion in market cap. And we don't know if they will be outcompeted, but if Apple, Nvidia, or indeed Tesla are outcompeted by other companies, then these share prices might not go up, but they could suffer a setback. They could suffer a very substantial setback. Investors might lose trillions, but most particularly the index itself may not actually produce much of a return. And in fact, there's a problem really with bigness generally. The law of large numbers really means that the world is finite in scale. Now, big companies can become very big, but they can't becoming bigger and bigger and bigger forever. There is a constraint to it. So what I did is just look back to 1990. This is as far back as I could. I looked at the largest 5 companies in the S&P index, S&P 500 index at the time. And what you can see here is that there were companies which we all know and love, IBM and Exxon and stuff. But what was interesting is each of these companies really struggled to generate a return which even kept up with the S&P index 500 index thereafter. In other words, once you get big, it gets difficult to keep getting bigger and keeping up. And sometimes companies lose that badly. If you look at Altera, it's still a company, but actually it's a much, much smaller company. And even companies in relatively attractive sectors, Bristol Myers Squibb, IBM, these have both been very good growth sectors over the last 25, 30 years. then they also still produced a return less than the index overall. So there's a real kind of sort of problem with getting big, in that you can't grow much. Some companies fail, some companies don't grow much. And the net effect is that actually markets themselves don't just keep going up. There are long periods when actually valuations come back to the previous norms, when profit margins come back to previous norms, when, of course, you may have recessions and earnings come down. And actually profit margins themselves, so stock markets themselves, actually can flatline. So the nature of it is that actually, where are small caps different? Small caps are different in that they start small. Clearly, they are not tiny companies. They're not corner shops. These are global companies, but they are, in many cases, employing hundreds or possibly thousands of staff, possibly making tens of millions of profit, not billions of profit and all the rest of it. And so in what is an example, this is an example of a company in the MicroCap Trust, for example. What you notice about U Group isn't so much that actually it's been a strong performer. You know, it's been held in the portfolio over the last 4 years. And what's been interesting about that period is it's actually outperformed Nvidia since we bought this holding for the trust. But what's interesting about it is Nvidia is standing at an extraordinary valuation, in it 10 or 20 times sales. Whereas actually coming back to U Group, yes, it has gone up something like 25 times over the last 4 years or so. But even now, its market cap of 277 million is actually less than sales. It's doing about 460 million of sales. Next year, it's forecast to do 674 million of sales. I happen to think those forecasts are low. Doesn't matter whether I'm right or wrong. This company, even though it's performed extremely strongly, the disappointment, if there is a disappointment, is actually its valuation is still not a reasonable valuation. It's still undervalued relative to other companies which are well positioned for the future, as this company is. And so that's the nature of it. They have not just the scope to succeed, but to succeed very, very substantially at a time perhaps when other companies might not be producing so much return. This is very much the exception at the moment. Microcaps, as you say, have been under pressure, but most particularly the opportunity is there for investing in these types of companies. And in contrast to Nvidia, which has also produced very good returns, this is a company which can deliver returns without going to extraordinary valuations or relying on investor enthusiasm, but actually is being backed up by fundamentals. So when you look back at the stock market generally, and this is just looking at the annualized return of a stock market, what you get is most of the stocks in the stock market produce a return somewhere around the average return of the stock market, some just above, some just below. There's some which disappoint badly, the odd one which goes bust. And then you can see off to the right there are some companies which produce not just a better return, but often 2, 3, 4, sometimes 5 times upside on their equity. And the opportunity, therefore, for investing across the market isn't so much just to invest in return, but actually to find companies which are able to produce not just an attractive return, but a sort of supernormal return. And we would argue that that's more often happening in small caps, particularly micro caps, than it is in the mainstream market. And most particularly, even when it does happen, they can continue to do it for more years in sequence than perhaps some of the very largest companies which run out of have the constraints of bigness ultimately. So most particularly, what's interesting about the stock market generally is over the last sort of 20 or 30 years, some technology companies have done really well. 1 or 2 of the business services sectors, there's been lots of takeovers. But actually, many investors have been able to do quite happily without necessarily having to invest in things like capital-intensive areas, energy, mining, financials, complicated financials, perhaps certain parts of the manufacturing industry. And what we're trying to show here is actually, as the world becomes more unsettled, as politics drives geopolitical tensions, you then find that at different times, sometimes valuations move against you. And we've shown here particularly the beverage index, the light blue area. And when we saw inflation picking up, a lot of the high-valued sort of drinks companies, Diageo, etc., came under pressure. But at exactly the same time, those pressures which have driven up the inflation actually boosted the returns in certain energy sectors. For example, you can see the oil and gas sector, things like Shell and things do pretty well. So we would argue going forward, the world's going to be more unsettled. Politics is going to become more of a problem. And actually investing across the full range of industry sectors rather than just a narrow range, we think is going to be an advantage. And we would argue in the UK, we've got a good wide range of different stocks to choose from and different sectors to choose from. And most particularly, what we need actually isn't just to make return, but often to make return when the stock market isn't doing much. What we saw with the pandemic wasn't just that, obviously we had a global recession and major stock markets kind of were okay, but didn't go anywhere. And at that period, of course, governments decided to invest hard on behalf of all of us to keep people in work through the furlough scheme. They spent a lot of money, from making sure companies didn't go bust. And this lent the amount of cash in the system grew, and particularly gold mining companies outperformed. And what we're just showing here is actually, even when things are flat, there are certain sectors sometimes which make heaps of money, and certain stocks within those sectors which make heaps of money, Pan-African resources in this case. And so coming back to it, there's a much wider range of needs. We're not just here to make money. We've got to find a way of making money through difficult circumstances, and we've got to find a way of making money even when many of the mainstream companies aren't doing well, when the global economy is in recession and actually valuations are under pressure. But that's all very well. What about recent years? Well, what we've tried to show here is the global small cap index, and most particularly how much the UK is behind. So basically, small caps have been under pressure for some years. They've been particularly under pressure over the last 3 years. What we've really seen is that actually many investors have really moved to participate in the global companies, the mega caps, indexations, passive strategies. When you buy a passive strategy, you tend to buy very big weightings in the very largest companies, and that tends to boost their returns. Equally, when you redeem an ordinary fund, perhaps an actively managed fund, you tend to sell small companies. And so we've had this move away from smallness to bigness, and that's really depressed things. Of course, it's been worse in the UK, where we've seen many investors moving away from the UK because actually the UK stock market's perceived as slightly old-fashioned, full of companies which don't really grow properly. And it's not so much international investors. International investors had largely pulled out of the UK, but local investors have been pulling out the UK fairly rapidly over the last 3 years. That's not been great for big companies, but they buy back their shares. They're cash generative. They can tolerate it to some degree. But small companies, they tend to invest in the future. They're not buying back their shares. And we've seen share prices, particularly of small, and most particularly microcap shares, fall to absurdly low levels, absurdly low valuations at the moment. Even when they're trading well, a surplus of local sellers, not many of the local buyers, has meant that valuations have come down an awfully long way. So when you look at the trust itself, what you see is this is a trust investing across a wide range of companies, across a wide range of potential sectors. And most particularly, it's mainly quite modest holdings. There's an awful lot of small holdings. Some people think that having 120, 130 holdings is kind of something which means we can't make up our mind. It's completely opposite. The opportunity for investing in companies which are well positioned for the future doesn't mean that we can always get 2% of the fund into a new holding. And sometimes they're quite small holdings and we can't buy even 1%. Not a problem. If they're too cheap because they're too small, they have more upside potential. When we think about U Group and we buying that for the trust, when we first bought it for the trust, it was a 16 to 18 million pound company. And clearly, it would have been lovely to put £1 million in or £2 million in, but that might have been practically impossible to buy that kind of stock. Much stock. As it happens, fortunately, we did get a decent weighting, and more importantly, as you know, it's gone up 25 times subsequently. Of course, that's become a large weighting in the fund. We've taken profits several times already. It's still a large weighting because we still expect the fund to actually outperform, this company to outperform, and most particularly, it's in a sector which is underrepresented in the rest of the portfolio. So there's a degree of diversification there. But then you can see other companies, Trufin, MTI Wireless, Sarabi Gold, Zephyr Energy, Zoo Digital. These are all companies where we believe they are on the brink of generating an outstanding amount of surplus cash. If we can get companies which are going through a period of investment, as it matures, then they can start to put cash into, they get cash coming in from the previous investment. They're in a position where they get surplus cash. They may buy back their shares. They may accelerate their growth. They may start paying dividends. Of course, they may get taken over. All of these things are a form of return, which isn't necessarily dependent on stock markets rising. It's actually dependent on the company itself thriving. And it's that opportunity to invest across a full range of companies, most particularly many of them quite small companies, 25 million pound companies, some 10 million pound companies, where actually even quite small weightings, if we happen to get into a company which does how its share price, which moves up 10 times, 20 times, 30 times, can produce a very good return for the fund alone. And if we've got a number of those, then that's the nature of the opportunity as we see it. And most particularly, what is interesting about the portfolio is it's so much more wide-ranging than many traditional small cap portfolios. As I say, many traditional small cap funds would be particularly concentrated on the mid-sized companies, some large end of the small cap ender. but most particularly they would tend to have a very large weighting in information technology, but most particularly very few in the materials, in energy, in financials. What you see in this portfolio is, yes, we do have a degree of information technology. That's about 18%, 19% of the fund. But we can see alongside that, materials, that's principally mining, some gold mines. You've got some financials. Again, it's a sector which is difficult to analyze, and you have to work very hard in that area. It's a complicated area, but most particularly when you get right, you can make a very good returns. And then there's industrials, i.e. manufacturing, utilities, that's principally U Group, energy, and as you can see, a full range of sectors. And it's that mix which gives you the diversification, which moderates the risk of downside when things go wrong. But more importantly, when unexpected events occur in the future and our assumptions have to change, sometimes some of these companies actually don't just suffer, they actually have greater upside potential. And it's that diversification thing which ultimately produces not just an attractive return, but a return hopefully which is a premium return even through more unsettled periods. When you look at the return over the last 3 years, last 5 years, it's been pretty disappointing. There is an absolute return over the last 5 years, but over the last 3 years, the bottom end of the market has fallen, the AIM market's fallen. This has been a period when actually even successful companies have not performed well in share price terms. Actually, even companies which have succeeded have not performed well. So although we're very, very pleased that we do have U Group in the portfolio and that it's moved up to a decent market cap, it's about 277 million as of today. But most particularly, the real disappointment for us is even as U Group becomes more mainstream, there's more fund managers looking at it, it's becoming analysed by a wider range of analysts. What we're seeing at this time is actually the valuation is still subnormal. If it had gone to a fair valuation, it might have gone up, 50 times or even more. So even the winners aren't going up much. Clearly, if you get companies which are disappointing, we always have a number in the portfolio which do disappoint, then their share prices suffer, and most particularly, they can suffer and fall to absurdly low valuations. So your losers are losing more, your winners aren't winning as much. Overall, the investment return looks disappointing. But as I say, when you look under the bonnet, and we do have some disappointments in the portfolio, but most of the portfolios continue to perform just as we expect. The companies are generating their progress, they're moving towards a cash surplus area. We think when they achieve that and when market conditions are more usual, then they'll get more recognition. And so we think that the valuations are absurdly low. The companies are continuing to succeed. And when that comes through, we think that the returns will start to become not just attractive, but we'll have a period of catch up. So what are the future from here? Well, this is looking at a chart of US inflation. This is going back to 1914. What you can see here is the zigs and zags of inflation. And what you see particularly prior to sort of the mid-80s was that inflation sometimes spikes extremely high. Sometimes we had deflation, as we had in the 30s, and it spikes extremely low. Well, what's been interesting about the period of globalization is as we've imported traded goods from overseas, particularly deflating traded goods, even though we've had local inflation, the cost of flat rental, the cost of professional services has continued to rise. But most particularly, we've been offsetting that with lower and lower costs of computers and imports. Then effectively, we've seen that inflation, it's not been completely flat, but it's been relatively benign, pretty much continuously over the period of globalization. Unfortunately, as I say, we're now moving towards politics, looking for fragmentation. We're seeing particularly local elections, international elections, driving for more nationalistic agendas. We're seeing geopolitics is becoming more tense. We're seeing a fragmentation of many of the major groups. This is all interfering with globalization. And as you interfere with globalization, you find that actually cost of imports starts to go up. Most particularly as you move to reshoring, that ultimately is inflationary. As you move ultimately to being more restrictive in terms of immigration, that leads to more inflation. Ultimately, we are seeing now inflation becoming more of a problem. Now, don't get me wrong, it's gone up now and it may normalize in future, but we don't expect it to be sort of, just as it was previously, a sort of Goldilocks, just right. We think it's either going to be too much or too little, and too little is equally bad as too much, because deflation tends to suck profits out of corporates. Many companies fail on that basis. So coming back to it, we think the world's going to be much more unsettled going forward. We think the profit streams from companies has been much more unsettled. And actually, companies with a lot of debt, particularly private businesses with a lot of debt, we think we'll find actually the cost of that debt isn't just higher, but they may struggle to roll it over at the end of the period of debt. So we think there'll be many more companies which become insolvent. Yes, plenty of the zombies will become insolvent, but many, unfortunately, highly geared companies will become insolvent as well. And yes, some quoted companies may become insolvent alongside that, but many of them are funded by risk capital. What we mean by that is not debt. Capital which is permanent capital for them, and if they don't make as many profits as this year, as long as they still are viable as a business, they will survive, and then next year they have the chance of being successful again. So we think we're entering a period of massive change, and that the pattern of markets will equally change. Alongside that, one of the features we think which will be most significant in terms of change is that we've got globally a pattern where many people who are in retirement put all their capital into some of the most exciting areas, perhaps some of the US technology stocks, for example. And as they go up, they take their retirement out in terms of profits on their portfolios. And that's great, particularly when valuations are rising very dramatically. But most particularly, what we try to show here is the effect of actually a stock market which produces around 5% per year, but just having a good start and a bad start. We've just reversed it through a mirror. So you can see that the same pattern, the same bars. And what we showed to that is if you happen to be putting your money into a stock market and you get a very bad start, perhaps the market's down 20 or 30% over the first couple of years, not only do you not have so much money, but actually because you need your retirement and you need to redeem some part of your portfolio, you actually have to redeem £5,000 or £10,000 worth of a portfolio which is already very small, and thereby you redeem a much larger part of that portfolio. It's very unstable in terms of producing that income. And when the stock market does recover again, because you've got many fewer investments, they don't go up so much. And of course, then when you have another down period, it tends to go. So what we've shown here is how quickly the capital runs out when you've got a bad start, blue, as opposed to a good start, black. And we think that in future, the markets will produce much less return. There will be back periods, not just 2022. We think it'll be a wider feature. And as that comes through, we think this is going to lead to an underlying change in behavior. And those people who are investing for retirement will be looking to invest in companies which don't just produce a return, but actually produce good and growing income. And it doesn't matter, you don't have to redeem units if you've got your portfolio, you just take the income from the portfolio over the years. And if the market's up or the market's down, it doesn't make any difference, and you're not carrying that liquidation risk, which is associated with that. And as that happens, we think markets producing good and growing income will become much more popular. In short, we think the UK stock market will become much more favoured, not just by UK investors, by international investors as well. And actually, the nature of the UK market is actually, people think it's actually full of old-fashioned companies which don't grow much. But the nature of the UK market really is it's full of capital-intensive businesses. What do I mean by that? I mean mining companies, of course, energy companies, financials, but also some of the manufacturing industries, for example. So we are actually in an area where we've got quite a large number of companies which are capital-intensive. And capital-intensive businesses don't just invest a lot of capital, but they generate a return through extra income. But what we've seen over the last 30 years is as the interest rates have come down, as bond valuations have risen, the cost of capital has become lower and lower and lower. And if you happen to be in an industry which was making a lot of money, then you've had a lot of extra competitors. In sort of stock market speak, you could say the moat around these companies has become shallower and shallower over the last 30 years. And for that reason, not only have they not grown as much as might have been expected, but actually their valuations have also been reduced as well. So the stock market itself has not really moved much. You still made a good return in the UK through the income and the extra income on the income as you have reinvested. But most particularly, what's interesting is the pattern is changing. Recently, we've seen the UK stock market break out of its long-term trend since 1999. And we think that's an incredibly important signal for the future, because we think that most investors have very little inkling of not just how much return can be generated by the UK stock market, but actually how much return can be made relative to the US stock market. This chart here shows the US stock market, S&P 500, versus the UK stock market. So when this is falling, the UK is underperforming. When this is rising, the UK is outperforming. So it's the UK divided by the US stock market, both in the current currency. And we all know what's been happening over the last 20 or 30 years with globalization and the technology majors and many of the innovative companies coming through in capital growth terms in the US. And we also know that the devaluation of the UK stock market and people moving away and companies finding the cost of capital comes down and they're being more competed with. But as we move into a more unsettled period, and we've been in a more unsettled period back between, say, 65 and 85, this was a period when we had Vietnam War, the oil price crisis, we had inflation, recessions, interest rates at very high levels. This was a very difficult period. This was a period when cash was relatively tight, as opposed to the last 30 years when cash has been relatively available. And companies generating surplus cash actually not just survive, but were able to acquire assets from the receiver, keep those staff in employment, but also get an extra return as a result of that. Don't get me wrong, the UK economy was no better than any other global economy, possibly worse, actually. We had valuation of sterling came down. We had the IMF came and rescued the UK in 1976. But coming back, aside from that, the UK stock market didn't just keep up with the US stock market, it massively outperformed. We think actually we're looking at the same kind of pattern. We take a lot of comfort in the fact that actually the UK stock market's just broken out, even while local investors are selling nearly flat out. We think this is an important moment for investors to start reassessing the value of different types of strategies rather than just following what's been working in the past. And most particularly, when you look at the stock market itself, the best performance is often not generated just by the mainstream companies or even the mid caps, but actually the smaller the company, the better performance. This is the data going back to 1955, and this is UK stock market. UK market is distinctive from other global stock markets in not just having a lot of mid caps and small caps. The UK stock market is nearly unique in the world in having a vibrant universe of microcaps. These are companies, say, below 150 million market cap. And what you can see is that dark blue line at the top is the best performing part. So if we're actually entering a period where valuations are going to come back to normal, where profit margins are going to come back to normal, where there's going to be more inflation in the future, where there's going to be more geopolitical uncertainty, then our assumption is that actually, as the valuations come down, as the profits margin, it may be the stock market flat lines globally for the next, say, 10 or 20 years. You can buy as much index funds and mega caps as you like, but actually their return may be very modest. And at that stage, we are going to see investors beginning to say, well, where can I get a return? And there'll be very specialist opportunities, including not just the UK stock market, we think, which will outperform, but the small microcap, particularly the microcap part of the UK market, which will outperform a rising market for the first time in 30 years. So, when we see our clients now, we don't just say we're looking to generate a premium return versus the FTSE 100. We're looking to generate a premium return versus the FTSE 100, which might become one of the best performing stock markets in the world. And that's really what happened back in the 70s. It was, a time when global economy was under pressure, the UK economy was under pressure, sterling was weak, international earnings, particularly dominated in that lower line, the FTSE All-Share Index, that black line at the bottom. But actually, what was interesting, as companies were able to acquire assets from receiver, yes, it enhanced the big caps, but that little incremental addition, if you started off small, was so much more valuable. And that meant that actually small caps, the light blue line, the bottom 10% of the market outperformed. But the best performing part of the stock market, and the UK was pretty much the best performing market in the world, was the small microcaps. And you can see that's the sort of brown line at the top there. So the microcap fund is focused in on an investment universe which we think is going to outperform, but most particularly the best performing part of an investment universe which is going to outperform. And we can add a bit of value through stock selection on top. We'll be excited. And almost the funniest thing about this is normally when you get to the bottom market, the local investors are still there and international investors come in. What's been interesting over the last 30 years is most local investors have exited. You can see in many of the insurance corporations and pension funds, that's the blue bit, have all come out of the UK over the last 30 years, along with many international investors. Yes, there are still some buyers. Some people buy Shell because it's cheaper than Exxon, active managers. But most particularly, if we do see the UK becoming a better performer, if we do see actually small caps becoming the best performing part of the market, micro caps best performing part of the small cap arena, then we believe that local investors will have to buy as well as international investors. We think the opportunity from here is truly exceptional. So going back to an investment trust has the advantage that it can invest in relatively small, less well-traded companies. Specifically, the great advantage of investment trust is that actually it's a fixed pool of capital, and as such, it doesn't have redemptions, which can mean if you're a unitized vehicle, you have to move into mid-sized companies rather than small caps. So not only has it investing in an area which is attractive, but it can remain invested in that area. Most particularly as an investment trust, because we have a redemption every year, it means that if their investors are investing, they know there's not overhanging sellers, institutional sellers. The discount, it varies, it can go to a discount, but most particularly, it doesn't tend to go out to the 20 and 30 or 40%, which you see sometimes in other small cap funds. Specifically, because there's more trading, as I say, the underlying NAV, it is a premium and a loss, a discount, but it's not as much. And most particularly, the fees The fund's become smaller over recent years. People have redeemed because it's been out of fashion. The fees of managers actually reduce if the fee gets too high, so that the overall fee never exceeds 2% of assets under management. That means the fund is alive, but more importantly, it's ready to fully participate in the upside when it comes. So in summary, I think we're looking at globalization, where companies which are funded by cash flow have been outpaced by companies which are more exciting. In the US, we think companies generating surplus cash will become much more important in this geopolitical uncertainty world. Specifically, we think that will drive interest in the UK stock market. We think, meanwhile, mega caps may run into difficulties because their valuations are already very inflated. And most particularly, as we get to more tense periods, we think there'll be a shortage of global liquidity, and that will actually not just favour the UK stock market, bring more capital in, but favour quoted companies, which are often those which are better financed, less debt. Specifically, we think that actually the UK stock market will be one of the best performing stock markets in the world. And we think that actually the opportunity for investing in companies which are generating good and growing income will drive investors into the UK stock market. And a part of that will then flow into the UK small cap, micro cap area. And even tiny amounts of money coming into this bottom end of the market, because it's so tiny, will make an incredible difference. The bottom line is, in risk reward terms, we are more bullish now than we've been for 30 years. Thank you very much indeed.
Thank you, Gervais. Very interesting. We've had a few questions come through already, but if you would like to ask them, please do so in the box in the corner, and we'll put those to Gervais. One of the couple that we've had through about sector weights in the portfolio. Are there any sort of standout sectors for microcaps at the moment, and have there been any changes on a sector basis for the trust over the past 6 months?
There hasn't been a change, very much change in the portfolio weightings. Specifically, we're quite cautious. We're not very bullish about the opportunity for a short-term pickup. We don't think interest rates, whilst the interest rates might be reduced, we don't think it's necessarily going to be the boost that most people think. In part, we think that they cut interest rates because demand has come down. So we think that that'll be tough. And in part, it may be that even if we do see inflation dropping away, governments continue to spend more than they generate from tax and other things. So we think there's a real danger that governments run into difficulty, not just in Turkey or Argentina. Even countries like the UK have the risk that actually, as our currency goes down, we start to import more inflation because there's less confidence in buying our own bonds. So that would just drive more inflation. It would drive more insolvencies. So coming back to answer your question specifically, the weightings of the fund are actually not very cyclical. We're investing in companies which are generating not just good return, but actually persistent return, irrespective of the global economy. Specifically, yes, IT is a good area. We think we can invest in some technology companies. The areas where we have perhaps got bigger weightings than we had, perhaps not so much 6 months ago, but say 5 years ago, is in some of the mining sectors. We think actually things like gold mining, we don't know how bad things will get, but if things get bad, of course, gold mining will do well. We've got some financials in there. We've got even energy stocks. And don't get me wrong, I think the world does need to move on from carbon-based energy. But most particularly, I think many of those companies are able to produce energy with less carbon intensity. And we need carbon-based energy, not just for energy, but specifically for all the plastics we use in hospitals and all that kind of thing. So I think actually, unfortunately, even in 2050, even though the global world may be at that stage, hopefully carbon neutral, there will still be carbon-based energy required for that reason.
Thank you. And there's a couple of questions on sort of the cash and gearing levels of the trust. It says that cash was 5.5% on a previous slide. Can you just talk through that level, and if you use any gearing, can you talk through the policy there, please?
Yeah. So we tend to have 3 to 5% cash in the portfolio at most times. Of course, that's marginally efficient. When the market goes up, of course, we produce less return on the cash. But most particularly, the huge advantage of having cash is that certain moments you suddenly find that a company comes into us and says, we're raising capital, and unfortunately we are in a difficult place, and the valuation is extremely low, and the cash payback is very quick, and we can move very quickly. And we don't want to have to be reliant on selling some of the existing holdings to raise the cash to put into the holding which we wanted to put in, and then miss the opportunity. So there's a real opportunity cost to having a little bit of surplus cash in the portfolio at all times, and that means that we're able to support secondary issues and primary issues along the way. And we have, Helix this year came to market. It was a very small issue. It was only 10 million market cap. They're drilling in the US for helium, and their share price actually, I know we've seen Raspberry Pis recently. But the bottom line, there have been opportunities to invest in primary and secondary issues, which have made good money straight away. To answer your gearing point, we think we can make plenty of return in this fund over the longer term. Being a trust which is focused in on microcaps, as I say, we think that's going to be the best area. Yes, U Group has done well. We haven't had many other companies which have done as well as U Group, not so much just in the last year or two, but actually over the last 5 or so years. So coming back to it, we think there's plenty more of those out there, but they just haven't been generating those returns. So coming back to it, we think we can make a return, longer term return, which is way above where we have been over recent years, and most particularly can compete well with most of the other small cap funds, possibly outperform most of them. But most particularly, we don't need gearing to do so. So why do we have the opportunity in the past of gearing the fund? Well, specifically, when we do find that markets have a particular sell-off, we saw in March 2020, of course, markets had a big sell-off. At that stage, after the market's fallen, if you are an investment trust, you can gear up. And we think that's a good time. If you're already geared, you can't because you've already used the debt. But at the bottom, we didn't gear up in 2020 because actually we didn't know at that stage what the economic effects were going to be. We didn't know whether we would actually have a vaccine going forward. So we held back. But we do have the opportunity within the fund at distressed times to actually think about gearing. We don't think we need it to make return, but we can add value. The last time I put gearing into my funds was actually in 2009, not 2008. After the bottom, we were therefore on the way up, the opportunity of making money, the markets were still not fully recovered at that stage, and we were able to actually enhance return at that stage. But you could only do it if you've got flexible gearing, i.e. it's not being used on the way down and it's there available at the bottom to make the extra upside, where you can actually take full advantage. You can bake in the underperformance of markets and the upside potential by using gearing at the bottom.
Thank you. A couple more questions on portfolio, then we'll go to more macro questions. There's one on the amount of miners there are in the portfolio. What's your sort of research edge on these?
I don't know if we've got a research edge versus, many of the private investors. I think many of them actually are very good at meeting companies and coming to their own views and all the rest of it. But the advantage we do have compared with most, professional investors is that most professional investors will stop at a certain market cap. They won't look at market caps below a certain area, say between 200 or 250 or whatever. So most particularly, there's quite a lot of companies there which are companies, which are small companies, which are small mining companies like U Group. It's not a mining company, it's utility. But many of these investors aren't actually willing to look at the companies irrespective of their investment merits. So actually, the opportunity for picking out companies in terms of materials is actually just meeting the companies. So our largest holding in the mining sector at the moment is a company called Amarok Minerals. Happens to be an Icelandic company, but it's actually quoted in London. It operates mainly in Greenland. It's bringing a gold mining company, a gold mine back onto production. But it's got the opportunity in Greenland, because unfortunately some of the ice has melted. They've now got a much greater opportunity to identify other areas. The risk-reward ratio looks unusually good. We're not more sophisticated than most other investors. I think most investors who met it would think it was quite a strong company. Another example, which is a company which has been in the portfolio for several years, Andrada Mining, which is a company which is involved in tin. It's onshore in Namibia. Specifically, it went into pilot production early on at our suggestion, rather than going into full feasibility. They just came into production. That generated cash, which has meant that their tin mine has continued to expand. They've now got lithium as well. So again, that's produced some great returns. So as I say, I don't think we're any more sophisticated than actually many of the private investors, but we meet the companies, we have the opportunities for investing in them, and we have much less competition from the professional investors.
And perhaps a quick follow-up question for that. What is the highest you'll go on the market cap spectrum? Is there a point at which you'll go, I think there's no longer microcap, we'll sell here?
Within the investment trust, we consider anything over 150 million to be non-microcap. That doesn't mean that there's a hard stop. If there's a company which comes to market at 151 million market cap, and we think it's got all the characteristics of being a microcap in terms of risk and reward, then we don't have to not invest in it. It would be ridiculous, having done all the work, to find a company which has just moved across them. So there's no hard limit, but principally, all the new investments are up below 150 million market cap. Clearly, when companies succeed, again, we don't have to sell as they go through 150 million. When they go to 151 and 155, as I mentioned, U Group itself has actually succeeded. It's currently 277 million market cap. So, it's clearly way above 150 million market cap. and it's the largest holding. And that doesn't mean that we have to sell back down or whatever. We certainly don't want to go much over 10. It can go over 10, but we would prefer to keep it a more modest size. But more importantly, when companies do get momentum and they have going through a rapid upgrade period, you might as well participate and at least allow your winners to win. And specifically, if View Group was to double in share price, say over the next 2 years from here, at the current position, that would add, several percentage points to return for our clients. So from that point of view, if we're into that virtuous spiral, let the virtuous spiral come through. So coming back to it, we tend to be below 150 million market cap, but we don't. That's not a hard and fast rule.
That makes sense. Thank you very much. So we'll move on to some of the broader questions now. One of them is inevitably about politics. Do you think that the potential election outcome will have any impact on microcap investing?
Well, the good thing about both political parties, main political parties, is that actually there's been a public debate over recent years about quoted companies in the UK, and specifically smaller quoted companies. And there's been talk about whether we should introduce an ISA, dedicated ISA for UK quoted companies. Because there's a question about whether pension funds should be putting more capital into the market. It's not had a big effect yet, but irrespective of what political complexion comes in after the election, we think, one, it's on the agenda, and that's really important. Specifically, we think after Brexit, we've got a more challenging environment anyway, with all of the geopolitical tensions. We think we've got a more difficult time anyway. If we do go into a period where there's recessions and depressions and unemployment, and all the other things which might happen in the future, we've got to make sure that the UK continues to actually not just succeed but thrive. And the nature of small companies, particularly small quoted companies, which have long-term risk capital, is that actually when they succeed, they generate skilled employment. They generate actually productivity improvement, and productivity across the globe hasn't improved much over recent years. And we think, UK needs to step that up. And most particularly when they succeed, being small and local, in many cases, they pay their profits, their taxes on their profits to the local exchequer. And that means that our government is able to put more into hospitals and schools and all the other things which they invest in going forward. So coming back to it, actually, we think there's a unanimity between both major parties about addressing the UK, finding ways for the UK market to succeed. We engage with both parties. We engage with everyone. Premier Miton itself actually led the idea of the UK ISA. Whilst it doesn't in itself make a lot of money in its start, it keeps the conversation going with the Treasury about supporting local companies. And once you've got 5,000, obviously that's a start, and then we can talk about the future from there. So going back to it, I think the election, does it make any difference? The nature of the choices in our UK government is not that radical either way. What's interesting is actually when you look across the channel to Europe, where they've got much more radical things, I think it makes a much bigger difference in Europe. And clearly, if you've got Trump Mark II, I think Trump Mark II, if he was elected, would be hugely more aggressive than Trump Mark I. I mean, in terms of protectionism, in terms of I think when he came in last time, he didn't have many of his lieutenants in the main ministries and all the rest of it. This time, he's going to be better organised. So I think we are looking at elections making quite a big impact on terms of geopolitical uncertainty. But I think the UK will be seen as an island of stability with a greater focus on the UK stock market.
That's encouraging, thank you. There was a question on the British or UK ISA, which I think we've covered. There's a further question specifically about the proportion of the trust in AIM-listed stocks, and whether you think that a potential change in government could affect some of the rules around IHT, for example. Does this affect your outlook on your AIM holdings?
Yes, so it's interesting, isn't it? Because I think the amazing thing about the UK is we've been out of fashion, the stock market's been out of fashion, and small caps, particularly microcaps, have been out of fashion really for the last 30 years. It's all been about bigness, and the US outperforms the UK in bigness. But we've kept the UK alive. Things like IHT, like having ISAs which are investing in the AIM market, has meant actually we've kept our smallness alive. And beyond globalization, I think we do need, yes, bigness, but I think we're going to need more smallness. And I think the UK leads the world in smallness. So coming back to it, I think as a starting point, thank goodness we've got all these things because they kept us alive. And as we go through the bottom point, that's going to be important because, we can only build on what we've already got. The UK is the best small cap market in the world in terms of viability and particularly microcaps. So coming back to as a starter for 10, yes, of course, government's going to run out of money. Of course, they're going to look at all these things. Could they look at the AIM, IHT things? Of course they did. We would argue that, given that the UK market's down, given that small cap valuations have been stuffed in the last 3 years, this is not a good time to be looking at it. We can't say they won't, right? But if they do, we think they'll only go for the top end. They may say everything below, say 500 million, it's still eligible for IHT relief. But if you're kind of something like, some of the major companies on the AIM market, in terms of Fever Tree and all that kind of thing, well, perhaps they won't get the IHT treatment. At the margin, it'll make things more complicated. But will it make any difference to this portfolio? None at all, actually. I mean, we don't have Fever Tree and that kind of thing. So coming back to it, yes, I won't say there won't be any changes, but I say it's a very bad time. We need to focus on small companies to generate employment, productivity improvement, and extra revenue for the exchequer. It would be a retrograde step if it did change. But most particularly, we've got some great arguments to have with government about this.
And can you perhaps talk about the dividend yield on the trust? What sort of the running yield of the portfolio is quite low as a thing which you probably expect from microcaps, but what's your approach to that?
So it's interesting. So most of the companies don't produce an income. Most of the companies are investing for the future. Clearly, many of the companies move through a period when they start to generate surplus cash. As they start to generate surplus cash, they then move into the dividend yields. So strange enough, this year, U Group has started paying dividend, having never paid a dividend over recent years. So coming back to it, yes, clearly what happens is as they succeed and as they become valuable and as the valuations move up and as they become bigger, then there's an opportunity for us to take profits. So just as U Group starts to produce lots of income, we often take profits on those kind of holdings and reinvest in other companies which are still immature. So coming back to sort of summarize, the yield on the portfolio is quite low. It's not because they're not actually companies which are set to generate surplus cash, which we think is important. It's because actually they're immature income payers as opposed to maturing income payers. So specifically, the income on the fund is small. Add to that actually the costs of running the fund and the management fee and everything else tend to go against revenue costs rather than capital growth. So from that point of view, there's also a cost in terms of local costs coming through on that as well. So both of those factors mean actually that the actual net dividend for investors is tiny, to be honest. And so it's a very nominal sum. It's a very tiny sum. But most particularly, that shouldn't be confused with the nature of the portfolio. As I say, these are immature income payers if we succeed, if we're lucky enough to get the right kind of stocks. And that's the nature of them. But as they become more valuable, we recycle back into other companies which are still immature income stars.
This might be our final question. We've gone a little bit over time, so thank you for giving us those extra few minutes, Gervais. There's been a question on your personal shareholding and that of the team. Do you sort of believe in the eating your own cooking approach of having a personal shareholding yourself? And what about other members of the team?
Yeah, so coming back to it, I've got a shareholding in Premier Miton. I've just got a home which I've bought over the years. But bottom line is all of my investment goes into my funds. One, because I think that the risk reward ratio is attractive. Of course, I've got a great understanding of what I think is in terms of risk reward rate. But most particularly, as comes over through this hopefully this meeting, is that actually I think the opportunity for generating not just an attractive return, but a much more attractive return, not just than mainstream markets, not just than the US market, but global markets is pretty attractive. So yes, we bought more. I bought more over recent years. Martin and myself both have shareholdings. Actually, it's grown over recent years because we think the valuation is so low. But generally, as I say, we tend to have all of our wealth in our local funds rather than anywhere else.
Well, on that very encouraging note, we might draw things to a close. Just leaves me to say thank you to all of you who are still listening. We've had amazing participation, so thank you very much for staying on and for the great collection of questions we've had. Gervais, thank you very much for your time and information. It's been wonderful. If you'd like to find out more about the Miton Trust, please visit our website. We've got a research note there available. And then we will also be hosting another UK event tomorrow, so don't forget to tune in for that. So finally, thank you very much, Gervais.
Thank you very much, Ryan, and a real pleasure.
Thanks. Goodbye.